Thank you for joining us for our live webinar on Seasonal Secrets, the Veteran's Guide to Successful Futures Trading. This is Eric Lee, your presenter for today. We will be starting the session proper at about 7:02 p.m. Let's give some time for friends to join us. Meanwhile, grab a cup of drink and relax, and I will speak to you real soon. Thank you once again for joining us for our live webinar on the Seasonal Secrets, the Veteran's Guide to Successful Futures Trading. This is Eric Lee here. I am a sales director with Philip Nova. In today's webinar, we'll be discussing about how we can make use of techniques from seasonal and cyclical analysis to trade the futures market. But before we begin, I would like to do a sound check. If you can hear me loud and clear, just type yes into the question box. Great. Looks like everyone can hear me clearly. So let's begin tonight's webinar. Okay, a quick introduction to myself. I joined Philip since 2004, so it's been almost 20 years now. Licensed to deal in investment products such as stocks, futures, forex, CFD, ETF, unit trust, and managing the investment portfolio of some clients as well. Kindly take note of the disclaimer. The examples shown here are for illustrative purpose only and do not construe as investment advice. Please talk to me further after the webinar if you are keen on trading or investing in certain markets. In today's presentation, I will try to run through some basic theories about seasonal and cyclical analysis, its use cases, and some trading examples. At the end, we will have some time for Q&A. During the webinar, if you have any questions, do type them into the question box and I will address them during the Q&A sessions at the end of the webinar. Seasonal analysis is like the little known cousin to the more popular school of thoughts when it comes to the investment research, namely financial analysis and technical analysis. However, in recent years, its popularity has been gaining traction among the investing community. To traders and investors, it is always good to have another tool at our disposal. Seasonal patterns refer to the tendency of certain commodities to experience price fluctuations at certain times of the year. These patterns can be caused by a variety of factors, which includes weather conditions, holidays, cultural or economic events. So understanding and recognizing these patterns can be a valuable tool for traders looking to increase their chances of making profitable trades. Sorry. There are several potential benefits of recognizing and trading based on seasonal patterns in the futures market. Firstly, it will increase our chances of profitability. By recognizing and trading based on seasonal patterns, traders may be able to increase their chances of making profitable trades. So for example, if a trader is able to identify a market that consistently experience price increase at a certain time of the year, they may be able to capitalize on this pattern by buying the market at a low point in this cycle and then selling it at a higher point. Enhanced risk management. By understanding the seasonal patterns of certain futures market, traders can potentially better manage their risks by entering and exiting trades at appropriate times. So for example, if a trader is aware of a commodity that a commodity tends to experience price declines during a certain period of the year, they may choose to exit their position before this periods begins in order to avoid potential losses, or they can also choose to tighten their stop loss level when it enters closer to this period. Advanced traders can even choose to short sell markets uh, when they enter these conditions. The third benefit is to improve trading strategies. Recognizing and trading based on seasonal patterns can potentially be a useful component of a broader trading strategy. By incorporating this approach into their overall strategy, traders may be able to make more informed and strategic decisions about their trades. And lastly, it will provide greater flexibility. By using advanced techniques such as intermarket analysis, traders can potentially take advantage of seasonal patterns in different markets in a more flexible and diversified manner. This may allow them to benefit from price movements in a variety of futures markets and potentially mitigate the risk of relying on a single market. Now let's take a look at some examples of seasonal trades. Let's look at crude oil. Crude oil is the bloodline of the global economy. Demand for energy tends to increase during the winter months due to its use for heating. And this increase in demand can lead to higher prices. Attached is a result of a simple test done on the price of crude oil during the winter period of the Northern Hemisphere, which typically starts from the beginning of December to the end of February. We have the years in the first column from 1998 to the year 2000. And then we have the second column that shows the closing price of crude oil at the last trading day of November. The third column shows the closing price of crude oil at the last trading days in February. The last column simply shows the change between these two data points. So by using the price of February minus the price of November, and we show it in percentage, so we divide it by the price in November, thus showing the price, the percentage increase or the percentage that it decreased. A positive return is highlighted in green and negative return is highlighted in red. So you can see that since 1998, crude oil prices are bullish 72% of the time during the winter periods. If a trader simply bought one lot of NYMEX crude oil futures on the first trading day of December, when the market opens, and sold it on the last trading day of February at closing price the following year, this strategy would have gained 84,000 in profit. So assuming if you were to start off with a 10,000 capital, that will be an 800% return over 24 years. The right side of the slide shows the equity curve of this seasonal pattern from 1998 to the year 2023, trading crude oil during the winter periods. Next, we look at corn. Corn is a widely grown agricultural commodity that is used for food, animal feeds, and other industrial purposes. In the United States, corn is typically harvested in the late summer and early fall, which can lead to a seasonal patterns in price. In the months leading up to harvest, prices may rise as farmers hold onto their crops in anticipation of harvest time. However, we can clearly see from the chart of the CBOT corn below, from 1997 to the year 2022, that prices typically peak in June, plus minus 1 month, and corn prices would then trade lower over the next few months after that. For your reference, I have plotted on the chart the vertical line, the vertical dotted line on the June of every year. So starting from 1997 June, then 1998 June, 1999 June, all the way until 2022 June. I had also indicated the high point every year with a down arrow. So for example, if you start with 1998, the peak of 1998 coincide with the uh, the June period that I plotted on and the vertical line. And subsequently, every year, you can see most of the peak either falls on June or it falls 1 month earlier or 2 months earlier in April or May, or it falls 1 or 2 months later after June. So clearly, there is some seasonal patterns over here. In fact, there's only 2 years when corn bucks the trend, and that's in 2010 and 2020, indicated by the two green arrows. And we know that both these years, the Federal Reserve started quantitative easing policy, which could be the reason why this seasonal pattern did not work in these 2 years. Other than that, it works pretty well like a clockwork. Thus, a futures trader trading the commodity market such as corn can then incorporate these seasonal patterns into his strategy and look out for shorting opportunities between May to August period. Or if he is holding on to a long position, then he can get ready to offload this position coming to the middle of the year. The next example, we look at S&P 500. There are a lot of seasonal patterns if you were to search on the internet that will show us regarding the S&P 500. Of course, we have the famous presidential cycles, and we have also the Santa Claus rally, which is and the January effect. So the Santa Claus rally is what I'm going to share with you right now. So historically, S&P 500 has shown a pattern of stronger performance during the period of November to April and weaker performance during the period from May to October. There's a famous pattern known as Santa Claus rally, though not consistently present every year, as it can also be influenced by a variety of factors. Yet it is still a pattern that some traders may take into consideration when making investment decisions. I've tested this simple strategy from 1997 to 2022. And you can see that there's a 70% biasness for the S&P 500 to rally between Thanksgiving week all the way until after New Year's Day. So when we apply a simple money management strategy, this strategy can produce a gross return of 480% over the past 26 years. Identifying seasonal patterns in the futures market involves examining historical prices for specific markets and looking for patterns that occur at certain times of the year. There are a variety of tools and techniques that can be used for this purpose, including statistical analysis, seasonal charts, and historical price data. Statistical analysis involves using statistical measures such as moving average, standard deviation, regression analysis to examine the price data and identify patterns. Seasonal charts plot historical price data over a specific time frame, such as 1 year, and show how prices have fluctuated during different weeks or months. Historical price data can be used to examine the prices of commodity over a longer time period and identify patterns that may persist over a number of years. It is important to note that while many futures markets exhibit seasonal patterns, these patterns are not always consistent and can be influenced by a variety of factors. Therefore, it is crucial to do thorough research and analysis and remain aware of the potential risks and limitation of trading based on seasonal patterns. As mentioned, there are a variety of tools and techniques that can be used to identify seasonal patterns in the futures market. And some of these tools and techniques are as follows. Firstly, we have the moving average. Moving average is commonly used by those who are well aware of technical analysis or using of charts to trade. And it involves calculating the average price of the market over a specific time frame, such as 10 days, 20 days, 50 days, or 50 weeks. Of course, some commonly used moving average are the 50 days, the 200 days, or the 250 days moving average. Then we plot this average on a chart. The benefit of this is that it can help us to smooth out the short-term price fluctuations, because on a day-to-day basis, the chart may just move up or jump down based on news or based on rumors. And the moving average will help us to smooth this out, thus making it easier to identify the trend and the pattern. The second tool we can use is standard deviations. There are many indicators such as the Bollinger Bands that has some form of standard deviations calculation inbuilt to it. So we can apply such indicators or such calculations onto our chart or onto our spreadsheet to measure the degree to which the futures price deviates from its average price over a specific time period. By examining standard deviations, traders can then get a sense of the volatility of the market and identify patterns in a way that in the way the price moves. So when the market deviates too much from the norm, this may also offer traders an opportunity to take the trade on the bet that the market price will revert back to the norm. Next, we have the regression analysis, which involves using statistical techniques or calculations to identify the relationship between two variables, such as these variables could be futures market price or some particular economic or business indicator. It may be with another market, or it could be with some economic data, depending on the products that you are trading. By examining the relationship between these variables, traders can potentially identify recurring patterns and use those patterns to make predictions about future price movement. Then we have seasonal charts. Seasonal charts plots out the historical price data over a specific time frame, such as 1 year, and show how prices have fluctuated during different weeks or months. By examining these charts, traders can get a sense of the general direction and magnitude of price movement at different times of the year. So that is one of the way that, as I demonstrated using the corn price just now, how we can spot out the seasonal patterns. Lastly, we have historical price data. Examining the prices of futures market over a longer time period, which could include several years or decades, it can provide us with valuable insights into the historical performance of the market and the potential for multi-year pattern to occur. This is how traders get the patterns such as the presidential cycle from. And this can be done by using a variety of sources, including futures price data from exchanges, historical price data from market-specific database, or it could be from financial news or some government sources. It is important to note that identifying seasonal patterns is not always straightforward, and we need to be careful to consider other factors that may influence the prices as well. This may include supply and demand. The most fundamental factor influencing commodity price is the balance between supply and demand. If a demand for a commodity is higher than supply, price will tend to rise. Conversely, if the supply is higher than demand, price will tend to fall. The COVID-19 induced lockdown was a great example. It had caused major disruption to supply of many goods and services. Unforeseen events such as this can cause prices to swing violently due to the temporary mismatch between supply and demand. Economic indicators such as GDP, unemployment rates, and inflation can also have significant impact on commodity prices. For example, a strong economic growth may lead to increased demand for commodities, which could then drive prices higher. This may result in policymakers adjusting their policies to fight off inflation, which may in turn affect the prices of these assets. Political and geopolitical events can also have an impact on commodity prices. If there is political instability in major producing region, it could disrupt the supply of a commodity and lead to price to increase. Case in point are the impacts of Russia-Ukraine war and the US-China trade war. These events had an impact on the global trades and also on commodity prices. The US and Europe sanctions on Russia had resulted in reduction in supply of many commodities, as Russia is a major commodity exporting nation. Natural disaster can also affect the commodity and asset price as well, like droughts, floods, hurricanes, the recent earthquake in Turkey. This will disrupt production and transportation of commodities. Technological advances can also influence commodity prices. The development of new technologies may make it easier to extract and produce certain commodities, which will increase the supply and putting downward pressure on prices. The global development of the electric vehicles had resulted in some prolonged underdevelopment in the oil and gas production investment. Thereby, this has causes the disruption and causes a huge fluctuations in energy prices in recent years. Changes in consumer behavior can also impact prices. Take, for example, the rise of the middle income group in China. This has resulted in this group of Chinese picking up the habit of drinking coffee. Thereby, if you were to read some reports, right, it claimed that there's a surge in demand for milk as a result of a surge in demand for coffee. And this result in the demand exceeding supply for milk in China. There are a variety of strategies that we can employ in the field of seasonal studies. I'll be sharing 3 of them tonight, and hopefully with the examples given to demonstrate to you how it can be useful in trading the futures market. Depending on the time frame that we are trading in, we can then incorporate financial analysis or technical analysis to further fine-tune on the timing in entering and exiting a trade that is being highlighted using this seasonal analysis. Adequate risk management measures are also very important to ensure that we are not overly exposed if the pattern does not play out as expected. It is crucial to have a well-defined trading plan in place before entering a trade based on seasonal pattern. The first technique I would like to introduce is this method called similarity analysis. This is a method of finding some analogies in the past to get some clues of how the market will behave and to anticipate what the current market condition promises in near future. Let's look at a chart here. The candlesticks bar in black are periods of the S&P 500 leading up to March 2009. Right? I have removed the candlesticks after 2009 so that we can pay attention to the red line here. Though we cannot forecast the future 100%, it is possible to find some analogies in the past to get some clues on how the future will be like. The red line here shows the price of S&P, but in the period from 1997 to 1977 to 1979, with price movement that coincide with the period leading up to March 2009. We can see that when we place the two periods side by side, that they are quite identical. Okay, let's pay attention to the left side of the screen here. The red line and the black color candlesticks, they are quite identical, right? Both in terms of the up move and the down move. And generally, that year has been in a downtrend, which are quite similar. It does not matter to us that 2009 and 1979 are separated by almost 30 years, because it is a human component that matters here. And the good news to us is that human behavior is the most stable thing in the world. So we can assume the same human behaviors when the market goes down, up and down 30 years ago is the same as it is 10 years ago and the same as it is now. Take note that the red line on the right side of the chart, which was what happened from March 1978 to March 1979. So we can see from the chart that period was generally an uptrend with some major low points in July 1978, November 1978, and March 1979. There's also an obvious peak in September 1978. So I hope you understand what we are trying to do here. We are trying to use similarity analysis to which is the using past data of the similar asset to predict the future. Now let's sorry. Now let's add in the candlesticks chart of the S&P from March 2009 to March 2010. So this is the candlesticks that I'm talking about, the black one. We can see that though it was not an exact match in terms of the magnitude of the fluctuation, it moved in a general uptrend direction, similar to the period in 1978. And some of the low points were picked up by the projection using the similarity analysis on 1977 to 1979. And this is interesting because the phrase history repeats itself is not just a cliche. It really does repeat itself. But this is not enough. Look, finding one analogy is not enough. We need to find more. So in the next step of the similarity analysis, we then find other historical time frame that had a similar market fluctuation as the period between March 2008 to March 2009. Then we combine them to form an average projection line for the next 12 months. I plotted them out on the attached chart, shown as the blue continuous line. So the blue continuous line on the left side of the chart is the result of combining 4 to 5 years of historical time frame whereby the market moved in a similar magnitude to what it is from March 2008 to March 2009. And the blue line on the right is the subsequent years of this historical time frame averaged together and then being plotted out onto the chart on the right, which forms a consensus forecast line or projection line. So similarly, the candlestick bars are the chart of the S&P 500 from March 2008 to March 2009. We can see that the blue line on the left are quite similar, right? That's our purpose, to find the historical time frame that are similar to this period in 2008. And then we project it forward on the right side of the chart. We can see that the projected trend is up. And there are 3 low points in July, November 2009, and February 2010. And there's also 3 high points in May, October 2009, and January 2010. Now let's add in the data of S&P from March 2009 to March 2010 to compare with the projection line. The general trend is up, as we have already known, right? 2010, 2009, this is history. We already known this has happened. The high points in May 2009 and January 2010, and the low points in July 2009 and February 2010 followed the projection line quite nicely. The ones in between are not so obvious, but we can see the general uptrend move as projected. And it is choppy, pretty much the same as the projection line. So of course, what's the use of using this technique if you only use it to project the history, right? Anybody can curve fit because the history is already known. So coming next, let's use this method to forecast the direction and the significant high-low points for 2023. Similar to what I've described earlier, the first step is to find out all the years with high percentage of similarity to the period of January to December 2022, because we're going to use this data to project what we should expect going forward to 2023. So this is plotted on the chart as the candlesticks bar on the left side of the chart. The red line is the price movement of 1974 on the left side and 1975 on the right side. The similarity of these periods is about 70%. One of the reasons 1974 was chosen is because the market condition now and then were pretty similar. In both periods, the market experienced the problem of high inflation and high interest rate. As such, the psychology of the traders, even though 50 years apart, could be very similar as well. Humans are creatures of habit and routine. Given the same market conditions, the traders generation apart may end up making similar trading decisions. One thing good to have is that whenever we are selecting the periods to be used for the similarity analysis, it always helps to know the history of what happened then, comparing to what happened recently. If they are similar, then it helps. The psychology of the market then and now, if it's similar, then it will likely result in a much more closer outcome. So similarly, apart from 1974, we find the other historical time frame that coincide with 2022, and we combine them to form a average projection line, which is this line here in blue. So on the left side, we have the blue line projection, right? And these are blue lines of historical past. Usually we try to find at least 3 to 5 years of historical time frame that has the similar movement, and we combine them to form this projection line. So the right side of the chart is also historical continuation of all these historical data, and you average them out to form a projection line. So as forecasted, this blue line shows that January is up, it's flat in February, March to somewhere around mid-May is the uptrend continue, then it starts to correct or starts to be a bit range bound all the way until sometime between August and September, after which the uptrend continues again until December 2023. As we are coming up to the end of February, we can then add in the data that we know so far into comparison. So let's put the data in here, as you can see, as the candlesticks up to February. So we can see that January was up as forecasted. February gave up half of January's gain. It's not exactly flat, but it is not exactly a big downtrend, more like a correction up to this point in time. So interestingly, we can see that there is a low point here somewhere in the beginning of March. So if this projection line were to come true, so it is projecting to us that we may see some low point coming up in the next 1-2 weeks, and then the market will go up as per projection until May, and you will then reach bound and before continuing and typically projecting a more bullish trend for this year. So this is similarity analysis. The next theory I would like to introduce is the wave theory analysis. This was pioneered by this author by the name of John F. Ehlers in the 1970s. In his book, MESA, M-E-S-A, and Trading Market Cycles. It is a technique used to identify market cycles, providing market forecasts and trading signals. Since then, there are other techniques introduced, some using mathematical formulas rooted in scientific research. And in a nutshell, wave theory analysis attempts to find recurring wave patterns and then projecting the wave patterns forward in assumption that these patterns will repeat themselves. The functionality of this technique is better explained by showing you some examples. Using the same example on S&P in projecting the time period from March 2009 to March 2010, we plotted out the wave analysis shown as the red line on chart. Unlike similarity analysis, which I've explained just now, this wave theory analysis, the direction of the red line, the direction the red line is moving towards is not important, right? So if this red line goes up, it doesn't predict uptrend. If it comes down, it does not predict downtrend. Rather, all we are interested in is the high and low point that this wave has pointed out. So simply said, this wave analysis, this wave theory analysis is used to highlight to us the major turning points over the next 12 months. So based on this example, on this time frame, the wave analysis had picked up June 2009 and January 2010 as the possible buy points, and May and November 2009 as the possible sell points. After including the data from March 2009 to March 2010, we can see that the two corrective waves were quite accurately picked up. But as forecasted, by the timing of the high and low were off by roughly a month. The actual optimal buy points were July 2009 and February 2010, and the actual optimal sell points were June 2009 and January 2010. Nevertheless, arming with these projections gave traders the early warning system to set up their trades and use other timing tools to enter and exit their trades in the market. Okay, in case you are curious, the software I'm using for this seasonal and cyclical analysis is called Timing Solution. This was developed by a Russian mathematician who started applying his research in math and physics onto the financial markets. So let's look at a chart here, which is using the wave theory to forecast 2023. Remember, I said before, the previous slide, This wave analysis does not forecast a direction. It simply picks up the major turning points for the coming few months. So looking at the waves, the potential high points are in March, May, and November. The potential low points in late April and between July and September. And another thing to note is that up until July, we see many oscillations. This may imply a choppy or range-bound first half of the year, and market will probably only start trending in the second half of the year. Now we can apply what we know of the general market or economic conditions to explain this forecast. We know that the market expects Federal Reserve to raise interest rates a couple more times, and that the inflation have been falling since mid last year. As such, this forecast may not be too far-fetched, right? As the market is in a lockstep with the Fed's policy. So until they stop rising interest rates, we may see some tug of war, which may explain the oscillations in the first half of the year. Okay, let's add in the data we have so far up until February. The two wavelets, the small waves that we see in January and February, looks quite in step with the two small wavelets that we see here in the wave theory projections. So coming up next, we should look out for the two high points in mid-March and May, and the low point in mid-April and subsequently in July or September. So take note that for wave analysis, the high point in March, even though higher than the high point in May, this does not mean that this theory is projecting higher high in May, March or May. It simply points out the potential turning point. It does not imply the magnitude. We may have a higher turning point in May, or we may have a higher turning point in March. We really do not know, because that's not how this analysis method is being designed. It's not being designed to tell us the magnitude, but simply to point to us the potential turning points. Okay, the last method I'm sharing is, to me, is perhaps the most practical. Intermarket analysis is a method of analyzing financial markets by examining the correlations between different asset classes. So by studying the different, by studying the relationship between different markets, investors can gain a better understanding of how changes in one market can affect other markets. However, it is useless just to look for two markets that are highly correlated if both of them move in locksteps together. So taking this concept further, not only do we want to look for two assets to be highly correlated, but we also want to look for one asset to be leading the other asset by a number of days, so that it can act as an early warning system for us to get ready to trade in the direction the one market has moved in. Take, for example, the chart shown here is the intermarket relationship between US inflation rate and the S&P 500. We know that high inflation rate has been giving investors a big headache over the past 1 year. And interestingly, even though inflation data is a lagging economic indicator, if we invert the chart of inflation and match it with S&P 500, it can be used as an early warning system for investors to get ready for the US, for when the US stock market will bottom. The relationship is not very consistent when the inflation rate is below 5%. But when we have inflation rate that is above 5% and we see a peak in inflation rate, then the S&P 500 is likely to bottom over the next 3 to 6 months time. As you can see here in the 2009 period, so the orange line here is inflation, but being inverted upside down. So the low point here is actually when inflation is high. So if you look at the readings here on the y-axis on the left, right, higher number at the bottom, lower number at the top. Right, that shows that this chart is being inverted, right? So you can see that as it peaks, inflation peaks, 6 months later, right, the S&P 500 bottoms, right? Similarly, in recent case, the inflation peaks some in June last year, and then about 3 months later, we see the S&P 500 bottoms, right, in October last year. So the lead time is roughly between 3 to 6 months. In between, when the inflation peaks but is lower than 5%, the relationship isn't very consistent. Sometimes it gives an early warning system, sometimes it doesn't. So, however, traders can incorporate this technique with technical analysis, or they can simply buy the index using dollar cost averagings 3 months after inflation peak, right? Doing this should greatly improve their trading result and can also avoid buying into the S&P index too early. Another more shorter term technique of this intermarket analysis is to make use of the relationship between natural gas and S&P 500. The candlesticks bar show the price of the S&P 500 up to middle of last year, June 2022. Right? Then it is plotted together with the inverted price of natural gas in purple line. So this is natural gas, but inverted. So when it is at a low here, it actually means that natural gas was trading at a high at that point in time. So the difference is that the inverted natural gas is pushed forward in time by 6 weeks. What this means is that the inverted natural gas leads the S&P 500 by 6 weeks. Thus, after the natural gas bottoms in July, 6 weeks later, the S&P 500 peaked and started trending down. After natural gas peaked in mid-August, then by early October, the S&P 500 bottomed and started its uptrend. So by following the inverted price of natural gas, we have a 6 weeks lead time to get ready for any change in trend, or if the purple line continues to trend higher or lower, it will give us the confidence to continue to hold on to our positions if we are trading in the same direction as the purple line, which is referring to the inverted price of natural gas. So since this is already passed, we will then add on the price data of S&P 500 to date to see the performance of this inverted natural gas as a leading indicator for S&P 500. And also we can see what we can expect 6 weeks from now. So adding the data, we can see that using an inverted natural gas as a leading indicator can give us 6 weeks lead time. And it helps us to pick up the major turning point here. So as I mentioned here, this turning point here is when the inverted, for the inverted natural gas, this happened 6 weeks prior. So if we were to lay these two charts side by side at the same time frame, this peak will happen somewhere around here, right? So 6 weeks later, then the S&P peaks, right? So similarly for all the up and downturn, right, that we see here. And that's exactly the beauty of using inter-market analysis, right? We find two assets that are highly correlated, but one of them moves earlier. So it gives us warning. It gives us, get us ready, right, to get into the trade. So statistical calculation using the timing solution software has shown that the correlation between these two assets to be about 73% over the past 12 months. So based on my observations, correlation above 60% is quite difficult to find, especially for those with a leading relationship. So thereby, most of the time, if I find one that is 60% or higher, it is good enough to be used. Because as I mentioned before, you cannot use this alone. You have to incorporate your other tools, your fundamental analysis or technical analysis, and incorporate them into the strategy. So since the purple line had continued to trend higher, right, from now, the expectation is that what this implies is that there is a 70% chance for the S&P 500 to trend higher over the next 6 weeks. And so far, I've been using the US market as an example to share about the various seasonal and cyclical analysis. But the same methods work for other assets and markets as well. And the last example I want to share using inter-market analysis is for the trading on the MSCI Singapore Index, also commonly known as the SIMSCI. This stock index futures is what traders used for trading the Singapore market, Singapore Index. 90% of its stock components is quite similar to the widely followed Straits Times Index. So for demonstration's sake, I have first removed the price data from SIMSCI. So because we are not looking at SIMSCI to project or to make any trading decision, right? We are using another asset, right, shown as the black line below. This black line below is not a technical indicator. It's not any indicator that you like MACD or RSI that you use in charting. It is a price chart of another asset, and which I will not be revealing now for the moment. And starting from February 2022, I mark on the chart whenever there's a price action which depicts the start of an uptrend or downtrend, following the markings on the black line below. So we can see that there's a sell signal on the 24th of Feb. So I mark down by vertical line. The red color horizontal line tells us the point that it breaks up or down. When it breaks up, I use a green line. If it breaks down, I use a red line. And then I'll add on a red color arrow or a green color arrow up to point out to you where at which point the signal is being given. So for the whole of last year, 24th of February, there's a sell signal. 19th of May, there's a buy signal. And then another sell signal on the 9th of June, a buy signal on the 21st of July, a sell signal on the 30th of August, a buy signal on the 21st of October, and then finally a sell signal on the 10th of February. And up to now, this strategy is still giving a sell signal, so holding on to the sell position. So now let's add in the candlestick price chart of SIMSCI for comparison. For practicality's sake, I had opted to buy Simsky the opening price at the opening price the next day after the signal was being given by the black line below. So for example, let's look at the first sell signal. The first sell signal given on the 24th of Feb. So the strategy then buy Simsky when the market opened on the 25th of Feb. So 25th of Feb, market open, Simsky at 329.45. So the market sell Simsky at the strategy sell Simsky at 329.45. So and then subsequently also you just follow on in May, it buy two lots, one lot to cover the sell position and the second lot to initiate a new long position, and so on and so forth until now, right? Which is holding on to a sell position. So trading Simsky based on this intermarket strategy would have yielded a gross profit of around 12,000 in 2022. So 12,000, I just estimation as at the end of 31st of December 2022. So if you include the position that it is in now, so it's roughly around 13,000 since the start of this test. Right. So before I end, I want to highlight that there are limitations and risks to trading based on seasonal patterns. So such that these patterns may not be consistent, as demonstrated earlier with the inflation comparison with the S&P 500. So and also other factors may influence the price as well, right? As shown in the corn example, right? It works every year, but when the Fed start their quantitative easing, it causes this pattern not to work. And it is also important to include risk management technique to limit the losses, because we do not know when the seasonal relationship will cease to work, or for any particular year it did not work that year. So we need to include risk management so as we do not to avoid huge loss in those years that it did not work. So thank you for joining us. I've come to the close of today's webinar on seasonal patterns in futures market. I hope that you have found the information and insights I shared to be valuable and useful in your trading endeavors. I have been in this industry for 20 years, and these are the various services I provide my clients to assist them in their trading and investing. As we wrap up, I want to encourage you to take a next step and consider opening a futures trading account with us. By incorporating the strategies and techniques we have discussed today, such as identifying and trading based on seasonal patterns, you can understand the ebbs and flows of the market better and use them to improve your trading. I understand that trading in the futures market can be complex and a risky business, and strongly recommend that you educate yourself thoroughly before diving in. With the right knowledge and approach, with the supports that Philip Nova provides, and with my years of industry and experience at your disposal, you can feel confident that you have the right guidance and support you need to succeed. So for those who are opening a trading account today, or you may want to think about it over the next few days, and then you find in with a trading capital of 3,000, you get to attend my traders masterclass coaching session, where you will be guided with the basic on technical analysis, setting up with your trading platform, and trading rules that you can use for trading the futures market, such as the specific rules I use for the Santa Claus rally strategy, and also the Simsky intermarket strategy that I've mentioned just now. Apart from natural gas intermarket leading indicators, you will also be notified whenever other intermarket leading indicators have been spotted. So to ensure that you appoint me as your servicing rep, you can scan this QR code or type this link onto your web browser, which will bring you to our account opening page. Okay, I will take some questions now. Okay, David asks, does the wave theory analysis take into consideration recession, soft or hard landing? No. The wave theory analysis basically is using past data. Like usually, if we use, let's say, Excel, or we've used a charting platform like the timing solutions that I use, you can set the parameters to, let's say, analyze the data over the past 10 years. And from the up and down move over the past 10 years, it then spot out the various waves that has the higher probability of repetition, right? And then such waves were being calculated and projected forward in time, right? So in a way, they do not take into all these fundamental or economical indicator or data, right? So of course, as a trader, we can then add in all this data into our own analysis to incorporate that for your trading. So it is always not advisable to just use this wave analysis or intermarket analysis alone, right? It's best to include some other indicators to help you. Okay, Sam asked about gold. Yeah, I do not have anything prepared for gold right now. So if you are interested, you can drop me an email. This is my contact details. Yeah, you can drop me an email to ask me, then yeah, I'll show it to you. Demo, someone asked about demo platform. Demo platform is free. Right, so that's all for we have today. Thank you so much for being a wonderful audience for tonight's webinar. A link to the recording of this webinar will be made available in our follow-up email to you tomorrow. If you have any query on the webinar or would like to get started, simply reply to our email and we will get in touch with you. This is Eric Lee signing off, wishing you great health and great wealth. Thank you.